that sometimes market makers get lazy, where market makers could take advantage of them, because that really shows like who's the bad guy out there potentially.
Hey everyone, welcome back to the VC Whisperer podcast. Today we're diving into the exciting world of crypto market making with a dynamic team that's shaking some things up. And joining us is Jelle Buth, co-founder of Enflux. Welcome to the show, Jelle.
So thanks for having me. My name is Jelle. I'm one of the co-founders of Enflux. And how I try and explain what we do is we help projects succeed or increase their chance of success by collaborating with them and teaching them more about their markets. And we do this by providing market making services in a very collaborative and transparent way. Been doing that for non-professionally for over 4 years. So trading personally as well with algorithms, and doing this professionally for around 3 years. First working at a different market maker. And now since close to 2 years, we started Enflux together with my co-founder, Valentin.
Driving from your experience, what would be a simplified overview of a market maker? What is its role within the massive blockchain ecosystem?
So it's a good question. I often think that market making is a little bit misunderstood. They think that we're these price pushers, pump and dumpers, volume generators, and cash machines that just bring lots of cash to projects. But in essence, market making is all about making sure there's a tradable market, there's liquidity on the book. In simple terms, for anyone who doesn't know how, at least on a centralized exchange and order book it works, is if you have limit sell orders in the order book and people buy, they buy from these orders in the book. As you can imagine, if there's no limit sell orders in the book and someone wants to buy, no one can actually buy because there's no liquidity. So it's our role as a market maker to make sure there's liquidity on the book, and there are different ways of doing that. And that allows people to trade and participate. For Bitcoin, for example, people can buy millions of dollars of Bitcoin in one single click, where for smaller tokens, it's all about being able to buy $1,000, $2,000 within one market order, just because there's liquidity. So in the broader terms of like the whole industry, right, I often explain the projects, our role is like, if you see adoption as the core outcome that you want, you have fundamentals, marketing, and liquidity, which are the core components of project adoption, where the project is often involved and mostly responsible for the fundamentals, like building something that people need. Then the second thing is you have marketing, making sure that people are actually knowing about your project and understanding all the issues that you're trying to solve. And then the third one is liquidity, making sure that if people want to participate, that they can actually have a place where they can buy, and that there's enough liquidity where people can buy. Where if you take the marketing away, you have a good product, people can buy because there's liquidity, but no one knows about you. If you take liquidity away, people can actually understand it. They know where to find you, but they can't purchase because there's no liquidity. And if you take kind of like the fundamentals away, you have liquidity, you have marketing, you kind of have Dogecoin, a meme token without fundamentals, right? So that's kind of like the role of us, making sure that an asset is purchasable, buyable, and tradable, and that drives ultimately adoption.
Even looking at the comparative landscape, there are quite a few market makers that are trying to step in, support products, support liquidity, etc. So what actually prompted you and your co-founder to launch a new market maker in the space? What changes did you want to introduce that you maybe couldn't find with others?
Good question. So I was working at a different market maker before, and the reason I wanted to start is because I was like, hey, there's something wrong in the space primarily, and mostly two things, right? I explained how fundamentals multiplied by marketing multiplied by liquidity is what drives adoption, so to say, which also explains that liquidity is such an important thing for a project. And it's so important that a market maker cannot just be simply someone who enables an algorithm and that's it. There needs to be collaboration. They hold certain knowledge that projects, especially smaller ones, don't have, which they need to communicate to the project so they can make better decisions and really be that partner and collaborator. Where we often found when we're talking to projects out there, it's simply, yeah, we have a market maker. I'm like, what do they do for you? And they're like, yeah, they do liquidity. And do you have any idea what they're actually doing? It's like, no. And like, do you chat with them on a weekly basis? No. Do you know what market making is? No, not really. I asked them some questions, and it's the market maker's role to educate these projects on the knowledge they possessed, right? And that was lacking. And the second thing is we're known for these sketchy. Market makers not really known for being transparent and trustworthy. We're often seen as these sketchy black box traders who have algorithms that no one understands. And there's no especially if we trade on client's account. I think it's important that we provide that transparency. Crypto is all about don't trust, verify, but who verifies the market maker? And actually, the market maker should provide the tools and the knowledge so they can be verified. And what that looks like is a dashboard where you can, over any time frame, see what is actually happening. Understanding what are the things that make a market maker good, the KPIs such as spread and depth, visible over time. And not a lot of market makers were opening up all the data that they have and kept for themselves to their clients so they can do their own verification, but also better understand their markets. So those two pain points actually led to like, hey, we need to make a change here, and we got to do this ourselves and hopefully make a change in here. And it seems to be going pretty well, because not only us that is focusing on this, we've seen other market makers slightly pivoting towards, the transparency side of things as well, which is awesome to see.
So you continuously mention dashboards and weekly calls. Is that what transparency means to you in your type of work, to kind of showcase what you're doing week to week basis, but also catch up with these projects and see what they need, where they stand, and where they're going?
Yeah, I think the collaboration is really about that last part that you said. Making sure that we understand what the project wants and asking sometimes like, hey, what do you need? And we do understand as well that our role is not helping them with marketing only. We have our connections, right? But we're not gonna, that's not our core business. We're not there to change their fundamentals of their product. But we are there, anything that relates to tokens, airdrops, OTC deals that are doing investments, is where we have a pretty clear opinion. Exchanges, right? And that's where we can have a lot of value. And really collaborating with them and talking on like a weekly basis. The transparency side of things is just making sure that they have a dashboard where they can verify what we're doing. But of course, there's transparency in two things: transparency in the data we provide, but also transparency in knowledge. Because if they don't understand what to look for in the dashboard, how will they be able to assess our performance, right? But really having those dashboards, I think, is crucial. It's the same as how I explain it is, you can go into Etherscan and verify every transaction, but will you do it? Probably not. It takes time. But if you really expect something, you have the ability to see everything that is happening. And it's the same for us. I hope they trust us, and they shouldn't spend hours in those dashboards because it's our job. But if they really want to see what's happening, they could go back in time based on every second to see what's up. And I think that's just a crucial role in especially the Web3 space, right?
What kind of new strategies or new working avenues do you introduce to actually help these projects see, look, we are transparent, we are good, we're established, and we're going to do what we are telling you we're going to do. So stick with us and not with these other market makers that they might not know that perhaps they're, pumping the image and pumping their, activities. But how do you differentiate? How do you actually translate that etiquette of work through the client?
It's a good question, because sometimes it's tough, right? Because if there's someone comes on board and says like, hey, we'll 20 extra token and we'll provide the capital, that's very attractive. So I think the only thing we can do is when we're on a weekly call with them, and we're showing the dashboards and the data, is to help them understand the value that we bring. That the next time they talk to a market maker, it's a question of like, hey, can you show me your dashboards, what you have? So they can compare, and they often see like, hey, it's not as much as we're used to. Do we have weekly calls? No, every once in a week is what they hear, or every month or something. What reports do you send? And then they can make a fair comparison between us, because they understand our value, and the other guy who tries to take it over in a way, right? Where if we would only be running algorithms and that's it, the comparison is easy. Someone comes on board and they only have to offer a cheaper price and they go with someone else. Well, if we really help them understand what proper market making is and what you can get for a specific price you pay, they're more likely to stay, so to say. So it's just about helping them understand the value that we bring and how market making should be done. And very few in that sense. I truly believe that most of the projects out there are really better off with us than anyone else, because I truly believe in the things that we do, and they can see that as well at some point, and then it's hard for them to kind of like leave. But of course they can. Like, we're not holding them hostage, but it's just about doing a good job in what we do and showing the value, which will make them stay.
A lot of people I talk to, like they know the key keywords, of like liquidity and market maker, etc. But they don't really understand what liquidity means. Why do we actually need it? Like how crucial it is, for someone like exchanges and market makers to tap into it and provide the role that they do for these projects, for retail, etc. So the overview of exactly how these things intertwine is very overlooked and has been overlooked for a long time. And talking more about market makers, what are the different types, and what is Enflux in particularly busy with?
What we as market makers do is we make sure there's liquidity. And liquidity can actually be done in two different ways. I guess there's two main models. You have the AMM model, which is like the Uniswap PancakeSwap model. And it's really cool because people can just put liquidity in a pool and it allows people to interact with that pool and there's trading possible, right? And it's called AMM because it's automated market maker model, which means that you don't need a market maker. You don't need us in order to have a tradable asset, which is awesome. Anyone can create an asset and have it tradable as long as there's liquidity. Where we are needed is actually on a centralized exchange primarily, or a decentralized exchange like DYDX, which works in an order book, where we are the one making sure there's limit orders on the book with algorithms, and therefore people can trade. There's not such thing as a pool. If you sometimes remove us, that's the same as opening up a liquidity pool, aka having a token that's listed on an exchange, but not put liquidity in there. It's listed and tradable, but it's hard to trade because it shoots up and down. There's a lot of slippage happening and there's no liquidity. Within the model that we do, where we are needed on centralized exchange with an order book, you have two models primarily, which is the token loan option generally, and then you have the service model, which we are using, where they pay a retainer fee for us to use their funds. We connect to their API keys to manage the assets and actually put liquidity on the book. Benefit is their assets stay in their custody, so they have custody of funds. We work in their best interest because we get a monthly fee, which is our profit driver rather than trading for profit, and we do what they actually want us to do, which is primarily providing good quality liquidity, which drives adoption. The other model is a little bit more complicated, I think, is where a market maker borrows tokens from a project, so they don't have custody anymore, and they say we will do market making, but there's no clear KPIs. You don't have full transparency and insights on what's happening. And they start to try and make some profit off the trading as well. There will be liquidity on the book, but it's often less quality because they're trying to optimize for profit. And then there's a so-called strike price agreed upon at the beginning, which means that at the end of the contract, they can buy back all of the borrowed tokens for that agreed upon price, which has a lot of complications, but I think it's a little bit too much to go into for this one. But those are generally the two models within a centralized exchange or order book market making that there is.
What about the projects that you do work with? Do you have a specific criteria for the onboarding process? Is there like some sort of non-negotiable checklist that you follow 100% of the time?
We could work with any project, right? Like any project needs liquidity if they're on a centralized exchange. If they're only on a decentralized exchange, they don't need us. So we could work with any project. But the projects we prefer to work with are the ones that are providing real value in the space, where the founders are focused on like a long-term goal, which is not making as much money as possible. So as long as we can feel like they're really focused on that, those are the clients we prefer to work with. Like I said, we could work with anyone, but we really prefer to work with the ones that provide a lot of value to the space, align with the things like trust, transparency, collaboration, and really value them. Those are the clients, at least when I work with them, I get most excited about and are the nice ones to work with, rather than the ones that are looking to make some quick bucks by liquidating a lot of tokens, right? So those are primarily the things we scan out for. And really, if we don't have a good feeling with a project and we're really focused on the wrong things, we have declined them in the past and be like, you're probably better off with someone else. I wouldn't say that's a hard checklist, but it's definitely just like a feeling that we have with the project, and we start to sense that pretty clearly in the way they talk and the way they set the goals for us.
So what is the concept of like value for you when you are reviewing these projects, talking to the teams? Is it purely about the team ethics and what they're trying to achieve and their kind of vision for the project, or is there an additional step in that kind of value evaluation for you?
The purpose of the token explains a lot on like what the founder is trying to do. If the purpose of the token is, if it doesn't have a purpose really, so the fundamentals are very low and it doesn't have a specific use case, like why do you have the token in general? And then the answer is often we needed fundraising and we need it. And that is sometimes, unfortunately, the truth for a lot of projects. There's not like a clear reason why you need that token, but it's there. And I think that really, it's like I said, it's not that if you don't have a specific purpose for the token, you're a bad project per se, but it does give a little bit of a signal of like, hey, what is then the reason you have that token, and try and like dive into that. So I think that is a big part of what I'm trying to understand in conversation. Like, what is it that you're actually trying to like do?
Because especially, of course, for partnerships with market makers, with partnerships with exchanges, the token is the crucial part. Even investors are completely obsessed with the utility of the token. We've seen over the past years a lot of projects launch without actually bringing any new incentives or any new capabilities for the token to actually bring the project forward. And that's one of the toughest criteria now to overcome. And even a lot of more projects are choosing not to go with the token because that could really hurt their like long-term approach.
Yeah, and I think that's actually good, right? It shouldn't be like, hey, let's create a token and put a purpose behind it. Let's be like, hey, there's a problem. And if the token and decentralization is the solution, that's where fundamentals come in. And one thing we see with projects that lack fundamentals is they expect us to do the magic. Like the market maker, they often think that the product that they have is the market making. That we're able to do price pushes and make a certain price chart, and that is then they see that as the fundamentals. But it's like, no, build your fundamentals, focus on marketing, and we take part of that third section only. We don't like the chart is not your fundamentals. Although how a chart behaves is sometimes seen as the best marketing ever, unfortunately. We're not responsible for that part.
So what do you need to make magic for these projects?
Our job is to make an asset very tradable, so it's attractive for investors and traders to get into. So it is almost like if you have proper fundamentals, if you do the marketing right, we'll be there to make sure that if they are converted into buyers and later into users or the other way around, they can actually buy. So that is where we come in. So if they never generated any traction, right, we're almost useless because we're that last step in that conversion cycle. If you have a funnel, you first have fundamentals of marketing, make sure the top of the funnel is done. People read the white paper, they're like, hey, this is cool. Then they do a lot of get active in the community, and then they decide like, hey, I want to purchase. If there's no liquidity, they'll drop off just before that. If you talk to a VC and you get them interested in investing in you, but then they check your liquidity and they're like, hey, I can't even buy $100 of this token, they'll drop off. So I think understanding that we're that last part of that conversion cycle in the funnel is really important, where we're not driving the attention. We're there that if you have driven attention, we'll convert them.
So as you mentioned, like market making can really be a double-edged sword. On the one hand, market makers can be extremely valuable assets to projects by supporting their long-term token strategies and market activities, but there are also quite a few issues that projects face with these market makers. So I just really want to pick your brain. What do you observe as the main pressing points within your service space, and how do you tackle them yourself, especially with competitors?
I think there's two main things, and one is a little bit more aggressive or wrong in my opinion. Is if I would, as a market maker, trading off the account of the client, right? And if I have my own accounts, I can make the algorithms in the market such that it's loss making and taking the profits on my own account, right? That is something that market makers could do because they control the market, so to say. They can misprice and then someone else can take advantage of that. That is almost sometimes invisible over a long period of time if the account is really big and if you don't have the proper dashboard for someone to see that and openly talk about it. That doesn't happen a lot, but it could happen. And we have some suspicions that it's happened before with projects where they just continuously lost money, and we then put our tracker on their accounts to see what's actually happening, and that's how we can investigate these issues for them. So that's one. But I think that the biggest part is actually just the fact that sometimes market makers get lazy. Like, and not sometimes, it happens quite a lot. And that means that if you give them a 20K account to trade with, in terms of tokens in value and dollars, and you only put $100 of liquidity on the book, that is underperforming and becoming lazy. That is not providing the value you should to projects, which is really creating a healthy market. And then they're taking it, and the reason I feel like that's unfair is because they're taking advantage of the projects. They don't understand market making, so they're just like, we have a market maker, and they're like, we're fine. But what we do, we then put our tracker, our public data tracker, on their account so we can visualize their liquidity, hop on a call and be like, hey, are you aware that this is happening? How big is your account? And then we're like, hey, we should not be the one telling you that we should probably put more liquidity on the book. The market maker should come to you and be like, hey, we're only putting $100 on the book while we have this much account. I would actually do this. Are you okay doing that? And really have that talk together. And they're like, why do you want to do that? Oh, yeah, because we believe your token needs more liquidity because there's a lot of buyers on the market. And then what are the risks? You explain it to them and really have that open dialogue where you're, as a market maker, have all the knowledge and you're steering that in the right direction and can actually make recommendations. But it's just the fact that that collaboration is not there and they're not getting the value that they pay for. I feel like so many projects can get way more value for the same price. Doesn't mean the market maker is really fucking them over, so to say, but just by being lazy and not proactive and getting the best for the projects, I think is just doing a disservice, so to say, which I think a lot of projects are suffering from, so to say.
Even if we look at the maybe competitive landscape for Enflux, do you think a lot of these other market makers are promising things that perhaps shouldn't be promised? And maybe you can make it a connection to actually market makers that are positive competitors and you actually look up to.
Yeah, maybe an example. We had a project which we took over from a competitor, provided significant value by collaborating with them, transparency, and of course doing the proper market making. They left us because there was another market maker who was promising 20x on their token, come up with their own capital. And we can't beat that. We can't tell them, yeah, we'll 20x your token because we just know that's realistically not possible. And 6 months later, they're coming back just because the promises that they made didn't end up happening. And there was lack of collaboration between the market maker and the project. And then they came back. So it was a good sign for us that it shows that if we just focus on the right things, people will flow back to us and they understand market making, understand how things should be done. That is okay if they try things out, but they often might see like, hey, we're missing some part. I think the second question was around like competitors in a way, right? That we look up to or
like
promises that they make. Yeah, I think one especially, I think I mentioned it before, that other market makers seems to be going in the same direction about transparency, which is cool to see. And I think one of the bigger guys out there that I wouldn't say followed us. I think back then they might not even knew we existed, but I think now they do is Flowdesk. They rebranded their website a couple months ago to more focusing on transparency, which is good. So because they're quite a big player in the space, we're looking up to them in that sense that they are having the same mission about making the space a little bit more transparent and doing the right thing rather than the thing that everyone wants to hear, which is go to the moon or making a token pump, so to say. Yeah, they're big guys and they're doing the right thing, and we're aligning on the same values, which is cool to see.
Right. And then, of course, there are issues like front running and wash trading. I feel like, especially in the current day, there is a sentiment, well, everybody's doing it. Why can't I? I need to get ahead to even be in the playing ground with these other competitors. I should also get into the dirt a bit just to catch up. Is there any way to justify it, or legitimate ways can get you there just as much? Maybe a bit slower, maybe not as bombastically, but it can get you there.
Let's take volume making or volume generation as an example. It's a tough one because I'm always like, whose fault is it that this is needed? I would almost argue that if that wouldn't be done by a market maker, you're losing 70% of your clients because 70%, 80% requires it. And if you don't want to do it yourself, you hire another market maker to do it. So you officially don't do it yourself, but you have a partner. So it's almost hard to not do it. Is it the project's fault because the project is asking for it and they're under pressure by investors and exchanges because exchanges request minimum amount of volume? Or is it the fault of an exchange that is putting 50K minimum volume requirements on their markets, which is actually fair to say you need minimum X amount of volume, but also they understand that you only get that by having a market maker that does wash trade? Or is it the fault of VCs and retail and stuff that they expect such high volumes, right? So it's a complex one where I don't want to say it's this person's fault. I think we all contribute to the whole thing, but I think the only thing we can do is just be transparent about the fact that it's happening and not pretend like wash trading isn't a thing and all the volumes on the exchanges are fair, because especially if you go to any non-top 100 project, and even exchanges do it, wash trading, there's a lot of fake volume in the space. What you should be looking at is DEX volume. Like that is the most realistic volume you can get. If your DEX has 10K in organic volume and the SEXs have 2 million, you can probably assume it's unfair, right? It's not really real. But even on DEXs, you can do volume making, to be fair. You just rotate a lot of accounts. There are ways around it, so even that cannot be trusted. And it's a pity, but I also believe that this doesn't only happen in the crypto space, but also in the Web2 space, to be fair. So it's a complex question where I don't really have an answer to, unfortunately, but it is something that is happening and it's hard to get rid of, to be fair, given all the people involved in these practices.
I mean, even taking into account all of these pain points with VCs and exchanges and market makers, do you think it would be possible to take one of them out of it and just kind of make it easier for products? So for example, can specific personal like trading strategies or some new tools make market makers obsolete and then make it easier for products, move forward without this additional checkpoint that they have to take care of?
I think it's already out there. It's just Uniswap and the AMM model for market making. And I think it's awesome because you don't need us. If you want to make an asset tradable, you don't have to pay 2 to 3K per month on paying a market maker to maintain that, right? So in a way, we're then obsolete, and that's actually a good thing because it's shitty for projects to have to pay that on a monthly basis, having to pay for an exchange listing while there is a good alternative there. But it's probably not being accepted as much because there's not as much volume yet. And VCs, retail put so much emphasis on centralized exchanges, like get listed there, that's to be fair, that's why we have business, because most of our business is on centralized exchanges. But it would be awesome if crypto would really succeed and everything is about adoption and decentralization and only decentralized exchange exists, then everyone has a place where an asset can be tradable and you don't need to go to a SEX and hire us, so to say. And then we're obsolete.
But isn't it a bit of a vicious cycle to kind of require these projects, have VC backing, have all these like ducks in line with like exchanges and launchpads, etc., and then put them in the same position, kind of like you need these to get onboarded, but also if you get them onboarded, like it's the same struggle with exchanges that they experience overall. Is there a way to actually get out of that vicious cycle for projects?
I don't know if this answered the question, but it's I think if I understand correctly, it's a good one, because sometimes I would actually suggest projects not to have VC backing. But if that means that they cannot get us as a grant, that would be a little bit strange, right? Because we're advising maybe against the VC that gets in and puts a different purpose on the project, because if the VC is heavily focused on taking profit rather than really building something great, then it's not the right VC to enter in, to collaborate with. So therefore, I would say it's not the hardest, right? Like it's something we take into consideration, but it's not a hard requirement or like that needs to happen per se. Because if they have a really good reason, if they build something great still and they are able to bootstrap it themselves, maybe with some family money, or they have had some startups before, I would actually say that's better and we will still support them. But those things will become clear with conversations that we have with the founders.
Yeah, that makes sense. And of course, I wanted to put you a bit in a tough spot because talking to a lot of founders and teams, like you really realize that a lot of, for example, infrastructure projects, they could really benefit of, not having a token or not even having the backers, and really focus on like the real revenue sources and real user base that they can build out from the get-go. And then of course there are other projects that could really need like that initial push of like capital and exposure with these VCs, and then the partners will like come flooding in saying like, okay, these VCs already did their due diligence, we trust their resources, we trust their expertise, and that really eases the life for us to onboard them and to kind of take on that risk. So it's a really like tough line to balance, and I wanted to see where you stand.
Yeah, that's a really good point, which is something I haven't really fully thought about, but when you said it, I was like, that's a really good question. But that's why it's also about a feeling. There's hard requirements, but also very much soft. One other thing as well where we sometimes help, right, is if we see that a project has been kind of like damaged by another market maker, I feel like it's our responsibility to help them out. So we bend the rules a little bit to still just help them out and give them still try and like see if we can restore that base and give them the right foundation, where they might not have VC backing. where they might be on the verge of actually going bankrupt, and we're like, we'll still, you've been fucked over, let's help you out a little bit. So yeah, it's all very much open-ended, but there are certain things that we look at which will make someone more likely to be accepted into the program.
Is there a different process of taking up on these broken projects by other market makers? What different do you do to help them kind of get out of that hole?
Yeah, sometimes it's so tough. Let's say we've had a project that did a wrong deal, so to say, with another market maker. The contract ended, and now the market maker has a lot of tokens in their hand. And the market is not big enough to absorb that selling pressure on the market. So there's only a couple ways to get out of it, is making sure that your project grows and there's enough buying demand to absorb that selling pressure, or you buy it up yourself. But what if you don't have funding anymore, right? You're in a very awkward situation where you'll have to preserve the dollar capital on the account and use as much as possible to really grow the product out there and see if you can squeeze out of that, right? But it's a tough situation to be in. So there's a lot of those decisions that need to be made, like where do you put your money? How much capital do we put back into market making? That's tough. Rather than like, hey, we start from like a very healthy base. Let's build up good quality liquidity and try and understand your markets while you're already doing awesome marketing, and see what kind of effect that marketing had on the token price or on the organic liquidity or organic volume. That's a different conversation to have. One is more, how can we get the best possible results with what we get, versus how can we get out of this awkward situation and reduce the amount of damage that has been done.
Yeah, I mean, it's a very fair point. And I feel like you don't even think about the projects that already had bad experiences. You know, you kind of always set out the models for new projects that come to you as the first straw, and then you can work with what you have, and you kind of have all that like risk avenues to take care of by yourself. You're not relying on anybody else. But when you, well, I don't really like to call them broken projects, but kind of broken, sentiment projects come to you. Hey, we've been really like fucked over. What can we do? Can we like still suffice? It's really like troublesome to take them on, because on the one hand you're really sorry for them. They might have a great strategy, a great product, a great roadmap, but it just not enough. You need to verify your partners, and that's the same with VCs as well. That's why I called it the vicious cycle before, because the people you align with can really, really, really impact your life, even though the impact should be very minimal.
That's why we want to get on board earlier, to prevent these things from happening, from them preventing to make the wrong deal. And especially if a project's actually at a tough spot financially, that's where market makers could take advantage of them, because they come with deals that is hard to resist, but also knowing that it's they need to cover their risk. So the bet that they make is very asymmetric, like skewed toward the upside really being for them. Mm-hmm. And if that plays out, there's a huge downside for the project. But they can do it because the project's at such a tough spot that they don't have another choice anymore. And that is shitty. And some market makers take advantage of that, which is unfair. But yeah, those are just tough things to cover with these projects and trying to help them out with. Where sometimes actually they die off, which is also okay, so to say. That's just like part of it. And some we're hopefully able to help, get back up after some time. But those things take a little bit longer.
Out of market makers, exchanges, and VCs, who do you think can break the projects the most?
Ooh. I think it's not exchanges, because the projects make a conscious call on which exchanges to go with, just as much to do with market makers, of course. It's tough because it all depends on kind of like the deal they have on the table and what they signed with. So it's more, if the market maker or the VC or the exchange proposes a really bad deal and they take it, it's actually themselves making the mistake rather than the one of the other guys. So it's just making sure that they don't make the wrong calls, the wrong deals, which is actually making sure that they don't break, rather than the VCs really breaking it. So I don't really want to pick any of the three, but if anything, it's probably the project itself that makes the wrong decision that is breaking the project.
You're going the diplomatic way. Okay, I will.
Yeah.
I mean, it makes sense. That's why there are always guidelines for these projects. Like, really know who you're putting on the cap table, really know who you're putting on your partner network, because then, as you said, it can really make or break your future. And it's, it's crazy to think that it is the case, but it's been, so in the Web2 business, and it's definitely not changing in the Web3 even more, maybe because relationships and trust are even more crucial here to establish.
I think the question that I would be willing to answer is who's making the most malicious deals out there, who's proposing the
Okay.
most malicious deals, is the VCs, exchanges, or market makers, because that really shows like whether who's the bad guy out there potentially. It's hard to say. I don't think exchanges really do it, because exchanges they have their standard packages, especially the tier 2 and 3 ones. And maybe go to top ones, they propose deals that are very expensive. Is it wrong? I don't think so. I think it's pretty transparent what the prices generally are for those things. I think that maybe market makers can take a lot of advantage of projects not knowing what the terms are and not being educated enough, where I think they take a lot of advantage of projects. And VCs, I think less so. I mean, it's also in their best interest to actually make sure that the project succeeds, because that's where their profit is, so to say. So I think the ones that can really destroy it are the market makers, because they can really take advantage of the lack of education that projects have, so to say.
I think with VCs, like the main difference is they have skin in the game, right? And even though they might have different incentives to, shorten the return on investment timeline or go a different direction that they think they can make more profits on, it's still making the project successful, at least like in a short term, which can be
Yeah.
detrimental. But in one way or another, like they are trying to push you forward. Is there a way for market makers to have some sort of skin in the game to kind of counter this detriment?
Yeah, that's a good one, right? Because if we're just getting paid a monthly fee, how do we align incentives besides just doing the right thing, right? It's sometimes market makers do a profit share, but I feel like that's not the right approach sometimes, because if you start to trade for profit, that's not the goal. The goal is to create a healthy market, so then you misalign incentives again. Sometimes what we do is we take payment in tokens with a certain lockup. So actually we have tokens then, and we of course want the product to do well. But this is not such an amount that if we are trying to sell that the project is suddenly back to zero, right? So these are acceptable amounts which we can liquidate transparently, and we say like, hey, we actually want to get rid of these tokens which are unlocking now. But that at least aligns incentive in the short run as well.
I love the transparency and actually looking at the future shifts where market makers can go. I think that's very honest, and I do agree in that regard with you. But of course, there are other things to take into consideration, right? Like additional support of the team that are experts in particular matters like tokenomics and liquidity, etc. And I think what you are trying to do as well with your grant program is to include that additional like USP to not become obsolete, in at least in the near future. Can you talk a bit more about it and elaborate why did it become a thing in the first place?
We just try and provide value to projects which now happen to be liquidity management. Liquidity management is still a thing even on a DEX, because you have Uniswap feed 3, right? So there's still business for us which we can do. But I think where there's still a lot of misunderstanding as well, just like how there's on market making, is on kind of like token launches and everything around that. There are awesome grant programs at the moment which are for to build something on a different chain. There's nothing for infrastructure. So we came up with an infrastructure, see market making as an infrastructure play, is to build a grant program which helps projects at the beginning of TGE. And I'm talking not about any project, but mostly promising ones, ideally with VC backing, that really have strong fundamentals. That's the ones that we want to work with and we want to support, and really help them in that whole process, where they also, before they even get listed on a centralized exchange, we can help them make the important decisions. But also the 3 months, if they have a centralized exchange listing, we support them with market making. Overall goal should just give them that solid baseline where they can build on top of and foundation, right? If we set that straight from the beginning, they have a higher chance of succeeding later down the line, rather than coming in 6 months after they have launched and already made some mistakes in the beginning, right? So if we can provide value around that and really set them up for success, we are therefore positively, impacting the whole crypto space.
Is there some sort of timeline where you're like, okay, we've done everything we can do, you can take it from here? Or is it really like a continuous growth alongside the project where you can continue providing your support?
I mean, projects go through phases, right? And the bigger they grow, a different phase they come in with bigger challenges. I don't think there's any business here that if they grow, they don't. It just happens organically, and there's no new challenges. And where there are challenges is where you can provide value and help them resolve that and give our opinion, actually connect them to the right people. So in my opinion, it's a continuous thing. But I do have to say that if we take over a project for market making, the biggest impact is really setting at that foundation in the first month. And then the months after will just be continuously, but it's not as much deep conversations as in the initial month that we actually start with a project. Just because we've set the foundation right, and if we set the foundation right, we just slowly put building blocks on top of it rather than having to build that whole structure out first.
Yeah, I feel like we could really talk about different intricacies and even connections with other platforms for hours here, but I want to be respectful of your time as well. Jelle, thank you so much for coming on to the show. I feel like we'll need to do another one of these episodes,
For
to
sure.
dive even deeper. It's really been great having you and learning more about Enflux and market making and all the difficult challenges for projects themselves, but also for you coming maybe not as a first kind of onboarded support system for them to tackle the issues that they've been having so far. So it's really been interesting learning that. Can you share with our listeners how they can follow your work, how they can reach out to your team with any inquiries, and especially where they can perhaps catch up with all of your writings about market making, transparency, and overall the ecosystem, and what you're trying to change there?
Yeah, I think the best way to learn about us and what we do and what we talk about is definitely LinkedIn. It's mostly my co-founder, me, and Farhad, our CMO, that talks a lot about these things. If you want to reach out to us, go to enflux.io. That's where our contact details are, and you can easily find us. Or LinkedIn, right? Just shoot me a DM. I'm happy to talk.
Thank you so much, Jelle. It's been so nice to talk to you. I hope we can continue on expanding the transparency and education in the space, both from the VC side, from the VC Whisperer, but also from Enflux and market making. And really excited to continue working together.
For sure. Thanks for having me.